Hello, this is Leroy Meadows, and welcome to this session. In this session, we're going to adapt standard costing method to process costing systems. And so this is a variation, and some industries will actually use standard costing method for process costing because there's a lot of different. There may not even be that many different materials or different things like that, but maybe a lot of different variations, such as textiles or steel. So let's go back to chapter 7 and just think about it for a moment. Standard costing system. What is a standard costing system? A standard costing system is where we predetermine how much material is going to be used in making of a certain product. We already know the price per unit of input material, and then the amount of labor that we should use in making each unit, and so forth. So we have a budgeted sales price, standard sales price. Direct materials will be budgeted cost per unit of input, and so will labor. Direct labor will be budgeted at how many labor hours per unit of input. And then with standard costing, remember we had variances. We had material price variance or cost variance. We had selling price variance. We had material cost or price variance. We had materials efficiency variance. We had labor. We had cost price efficiency variances for labor. And then we had our overhead variances as well. And then remember from the difference between fixed cost and variable cost, or fixed overhead and variable overhead, is that variable overhead we had a price or cost difference. We also had an efficiency variance. With fixed cost, there is no efficiency variance, but we do have a production volume variance, which is tied to capacity. So, refreshing our minds on that standard costing system that we learned about in chapter 7 when we dealt with flexible budgets and comparing budget results to actual amounts. We were introduced to a standard costing system, and we had to isolate those variances and then put them on the books. So now, how can we use principles of standard costing in a process costing system? Well, remember that process costing systems produce masses of identical or similar units of output. So it's easy to budget quantities for inputs needed to produce a unit of output. We can take the standard cost per unit of input and then multiply that by the input quantity standards to develop a standard cost per output unit. For example, if something takes 2 direct labor hours to make, we would have that, and let's say the cost of each labor hour is $15. So $15 per unit of input times the number of inputs needed, 2 hours, gives me $30 per unit of output with regards to direct labor costs. So now the weighted average and first in, first out methods do become complicated in certain industries: textile, ceramics, paints, packaged foods. Wide variety of of similar products. We may not have that many different materials going in, or the operations. If we're looking at operations, we may not have that many different operations, but the amount of combinations, if we have a lot of different combinations using the few differences in direct materials and operations, if we can use those in different combinations and have a wide variety of products, then broad averaging, for like we did in process costing, each unit would be inaccurate. Why? Because we have a wide variety of materials, so we can't just lump everything together as far as direct materials and then spread that out over all the different units. As we learned in operations costing in the previous chapter, in the previous, not the same chapter, the previous segment, each operation may require a different amount of materials or a different kind of direct materials, and it would be unfair to spread out the total material cost over all units when there's a difference in cost because of specific work orders or because of specific combinations we're using. So our product cost is going to be inaccurate. So therefore, we typically want to use the standard costing method of process costing. So what we're going to do is identify standard cost for each product, and then that will help overcome and get us away from the disadvantage of costing all products at a single average amount under actual costing. So let's go back to our Pacific Electronics. This time that we used in the book, in the earlier chapters, or the earlier segments rather, but we're going to do this under standard costing. We're going to compute the same amounts for February and March data. We're going to use the same standard cost apply in February and March. So the standard costing is going to apply to both February and March data. One thing you'll notice here is that there, at the very beginning of our production cost report, we're going to have a standard cost per unit for direct materials and for conversion costs. We know that each unit should have, for each thing, should have $74 of direct materials, $54 of conversion cost. Now we'll take a look at work in process, the degree of completion of beginning work in process, and we're going to figure out the work in process, the value of work in process inventory at the beginning at standard cost. So how am I doing that? I am taking my units in process at the beginning inventory for 225 units. I'm going to multiply that by my direct material standard cost per unit of $74 to get $16,650. I'm also going to take my work in process from beginning inventory, 225 units. My standard cost for conversion cost is $54 per unit. So and that is 60% complete. So I'm going to multiply that and then get, 225 units times $54 per unit and times 60%, because they're only 60% complete. I'm going to get 7,290. So my total beginning inventory is going to cost 23,940. Now let's figure the work completed and transferred out, 400 units. So they're going to be 100% complete with respect to direct materials and conversion costs. And my degree of completion for ending work in process, we're told that direct materials have already been added. And then we have degree of completion here for conversion costs. Now we're told that our actual total costs added during March, 19,800 for direct materials, and for conversion costs, 16,380. So my total costs, actual costs added during the month, $36,180. So now, that is our basic data. This is our basic data here that we have. So now under standard costing, when we do step 1 and 2, we're going to see that the completed and transferred out during the current period, we actually see that we follow the first in, first out method for completed and transferred out during the current period. First units in, my beginning inventory are the first ones out, and to compute the equivalent units for direct materials and conversion costs, we multiply that by the percentage we have to add this period, not what was already been done, but what are we having to add this period. Then the unit started and completed. By definition, if we started it and it's completed, then we added all the costs of direct materials and all conversion costs this period. And then the work in process and ending inventory, we're going to take our ending inventory units and multiply that by the degree of completion in this period. What do we do this period? Because remember, first in, first out focuses on what do we do this period. How much should we add to beginning inventory? How much should we accomplish for what we started and completed? And then how much did we already contribute to the work in process ending inventory this period? Now, let's take a look here. And now in step 3, we are going to value our beginning inventory by our standard cost. Remember, our standard cost is $74, and we know that it did not change because the book told us. So standard cost for direct materials, $74. Standard cost for conversion costs, $54. So we're going to value our beginning work in process inventory using those standard costs. And then we're going to add in costs added in the current period at standard cost rates. So in other words, the costs added in during the period, $275 times $74 per unit for direct materials and $54 per unit for conversion costs. Where are we getting these numbers here for costs added in during the current period? Where are we getting those per unit, or not the per unit? Where are we getting those number of units here, the equivalent units here? We're getting that back from right here. This is where we're getting our units. So step 3 is going to take the equivalent units computed in step 2 and multiply that by our standard cost for the month to get costs added in during the period. Our standard cost per equivalent unit is going to be our standard cost. We're not going to have to take total cost to account for and divide that by the number of equivalent units. No. Step 4, our cost per equivalent unit is the standard cost that we're told up here. $74 and $54 respectively. So we'll do that. And then we're going to take our standard cost and then actually use that standard cost to value our costs added to beginning work in process inventory in the current period, and then the unit started and completed, and then finally to work in process ending inventory. And then we're going to have that. So, and then we can add in our costs added through the period as standard cost rates. These are our standard costs. We're going to subtract from that our actual costs. We were told up here that our actual costs were right here for materials and conversion costs. So my cost added in at standard cost should have been $20,350. My actual for direct materials, my actual cost for direct materials came in at $9,800. So the variance for direct materials is $550 favorable. What about conversion costs? Well, my conversion costs added in during the period at standard costs, well, based on standard costs, I should have added conversion costs of $17,010. However, how much in actual cost did I convert for conversion costs? I incurred, $16,380. We're told that right here in the information here. So when I subtract the difference between the two, my actual cost came in less than my standard cost, so my variance is favorable by $630. Now remember that when actual costs come in less than our standard or budgeted cost, that is a favorable variance because that's an addition to operating income that we had not planned for. If my actual cost would have come in more than my standard cost, then it would be an unfavorable variance. Why? Because that additional difference here is going to hurt my operating income based on based on the operating income I computed under standard costing. So now I have my variances here. And then how do we account for the variances here? Well, let's take a look here. The assembly department, direct materials, we're going to record the actual costs and what we paid for them. And this is here is what we're going to debit assembly department, direct materials, credit accounts payable, and that's to record the actual purchase of the cost. What about conversion costs? We're going to record actual conversion costs of $16,380. We're going to debit assembly department conversion cost control. And then we're going to credit the various accounts such as wages payable, accumulated depreciation, and so forth at $16,380. Now, entry 3, 4, and 5 users are using standard cost amounts. So we're going to debit work in process for using materials. We're going to debit work in process for the standard cost. What should we have incurred? We're going to credit the assembly department direct materials control for $19,800, the amount we actually spent on direct materials. And then the difference we're going to record as $550. In this case, we have a favorable variance, so that is always a credit. Unfavorable variances, if you remember, are always debits. So we want to make sure we have that. And in case we're not sure, if we know what our standard costs are, we can debit that for work in process, credit direct materials control for the standard amount, and then fill in the gap to make our debits equals our credits. And I can at least get the journal entry right. If I know that my credits are favorable variances, then I can determine it here. Another way to do it, though, is did my actual costs come in under my standard costs? If they did, they're favorable. If they didn't, they're unfavorable. So let's look at this right here. What about work in process assembly at standard cost for conversion costs? We allocated $17,010. So I credit my conversion cost allocated and debit work in process for $17,010. Now, and that's to record conversion costs allocated at standard rates to the units working on in March. Now we're going to record the conversion cost variances. We're going to debit assembly department conversion costs allocated, credit assembly department conversion cost control, where we're accumulating all those costs. So I'm really closing out in this portion here. I'm really closing out the accounts and then crediting or debiting the difference. In this case, $630 favorable variance. And then finally, transferring from one department to the next will always be a standard cost. Why? Because I want to isolate those variances within each department. I do not want to carry those variances over to the next department. So I want to isolate those variances in that department, close it out, and that way when it goes to the next department or process, then we're starting with a clean slate. They already have their standard costs for direct materials and conversion costs, and that way we're not carrying over some of that negative effect. And why would we not want to do that? We wouldn't want to do that because if we have a lot of variances, we want to be able to isolate them where they're occurring. If we can isolate them where they're occurring, then we can further look into and practice management by exception, where we're focusing on areas that need more improvement than areas that don't need as much improvement, or areas that are operating quite well. We don't focus on them as much. Yes, we look at them from time to time, but they're smooth running. Those areas that are producing and are running smoothly and are working good, then great. Let's not worry about those as much. Let's focus in on the departments and processes that are struggling. And that's why we want to isolate variances in each of the different departments, because if we don't, then we have then we don't know where to look. If we wait to the end of the period, or end of the whole process, when we have finished goods units, rather, if we wait till they're all finished goods, what do they go through 3, 4, or 5 departments and processes? If we wait to isolate the variances at the end, we don't know which department or process that those variances occurred or that we had a problem. So that's why we want to isolate those variances in the period in which those variances occur, and not only in the period, but also in their respective department. So, and let's get out of here. And how do we look at the variances and then this flow of standard costs in a process costing system for the assembly department? Here we are assembly department direct materials control. We're transferring that to work in process. We also have conversion costs that are allocated, $17,010. We are doing what? Now we had our beginning balance. We transferred this $51,200 out to work in process testing. We're going to have our variance of $550 here. We see where this and these are all tied in together. So we got a complex diagram here, but we can see the interrelationship between the favorable conversion cost variances, as well as the favorable direct materials variances here. And remember, they're credits entries, so they're going to be credits in our T accounts. If they were unfavorable, they would be debit entries on our books, and then also debit entries in the T accounts. So, and that concludes this session where we talk about standard costing and how we can adapt it to a process costing system to make it more straight across the board. Especially we take a few different inputs and have a wide variety of output that we can have. And we talked about it, textiles, ceramics, things like that. Standard costing proves very beneficial when we have a wide variety of products that we offer. So this is Leroy Meadows. Thank you for joining me this session. Have a good day.